Brad Garlinghouse just sent a clear message to every skeptic in the industry. Ripple is the only blockchain company solving real-world problems with real customers, right now, at scale. That claim isn't marketing fluff. It is supported by a growing stack of partnerships, regulatory approvals, and hard numbers that traditional finance cannot ignore. In this video, we break down why that single statement could reshape how institutions view XRP, Ripple payments, and the newly surging Ripple dollar stablecoin, while a shifting macro backdrop sets the stage for explosive adoption. First, context. Tomorrow, the White House expects Donald Trump to sign a sweeping tax reform package, while Brussels and Washington hint at a fast-track trade agreement. Those two headlines may sound geopolitical, yet they directly affect payment corridors. Lower corporate taxes free up cash that multinationals can redeploy. A friendlier trade framework reduces friction in cross-border commerce. When capital accelerates, settlement rails become a bottleneck. That is the exact inefficiency Ripple built its network to eliminate. Enter Ripple Dollar. U.S. Treasury Secretary Scott Bessent just acknowledged more than $2 trillion in latent demand for regulated, dollar-denominated stablecoins to settle treasury markets. $2 trillion, roughly the GDP of Italy, sitting on the sidelines waiting for compliant rails. Ripple Dollar already carries the New York Department of Financial Services green light, yet mainstream media barely whispers its name. That silence is strategic. Incumbents don't advertise the disruptor racing up in their rearview mirror. While the spotlight lags, adoption surges. Amina Bank in Switzerland confirmed institutional support for Ripple Dollar, pushing the token beyond theory and into production-grade settlement. This is not an isolated pilot or a marketing proof of concept. It is a commercial bank wiring real value for clients. Each Ripple Dollar minted increases the liquidity backbone behind Ripple payments, and every transaction routed burns tiny amounts of XRP, tightening supply and reinforcing the feedback loop David Schwartz designed for price stability. Look at the ledger. 14 million Ripple Dollars minted yesterday, 16 million today, and counting. Ripple is stocking the tanks before the engines roar to full thrust. Parallel to the minting spree, the company has requested a U.S. banking license. Hard evidence that Ripple plans to plug directly into the regulated core, not merely circle around it as a fintech outsider. Once licensed, Ripple can custody fiat, issue credit, and settle like any other bank, except it will do so on rails measured in seconds, not days. Garlinghouse's declaration reframes the market. Memecoins chasing virality fade when CFOs demand auditable, regulator-friendly solutions. Projects such as Ondo finance the tokenization of treasuries. Mantra links real-world assets to DeFi. Yet XRP already tokenizes U.S. debt instruments on a chain that has never suffered a single second of downtime. Utility is king, and XRP wears the crown because it already moves dollars, pesos, and euros for live customers. Zoom out further. Treasury markets dwarf the entire crypto sector. Even a 1% share flowing through Ripple Dollar would eclipse daily volume on most exchanges. As that flow scales, institutional desks inevitably require deep XRP liquidity to arbitrage corridors and rebalance pools, driving organic demand rather than speculative froth. Remember, every institutional transfer that rides on XRP shaves costs compared with Nostro accounts, but also incinerates a sliver of the token's finite supply. Scarcity enforced by mathematics, not marketing. Critically, Garlinghouse's claim passes the sniff test because the competitors he references are still courting pilot programs while Ripple operates production lines. Stablecoin issuers boast TV commercials. Ripple files for a banking charter. Tech giants talk metaverse. Ripple powers payroll in emerging markets. The delta between promise and delivery has never been starker. The macro tailwind matters just as much. A Trump tax overhaul repatriates offshore profits and magnifies the need for rapid corporate treasury movements. An EU-US trade pact could slash tariffs, prompting a surge in transatlantic invoices settled in near real time. Treasury Secretary DeSantis' endorsement legitimizes stablecoins on Capitol Hill. All three developments converge on one question: which network can settle, audit, and clear those flows under regulatory scrutiny? Garlinghouse is betting the answer is Ripple, and the data agree. The retail investor. Today's XRP price may seem disconnected from that narrative, but markets often misprice infrastructure until utility becomes impossible to ignore. Fiber optic lines existed years before Netflix. Cloud servers matured years before AI went mainstream. Settlement rails follow the same curve. When liquidity flips from anticipation to necessity, valuation gaps close violently. What should you watch next? Track the banking license timeline, Ripple dollar minting velocity, and corridor-specific burn rates. Measure on-chain metrics, not social buzz. If Amina Bank is the first domino, which European or Asian institution is next? When treasury desks start using Ripple dollar for overnight repos, the floodgates open. If this breakdown sharpened your perspective, smash the like, subscribe for more institutional-grade insights, and drop a comment. Will Ripple dollar overtake USDC in treasury markets? Is Garlinghouse right that real customers plus real problems equal real dominance? The rails are clicking into place. The question is who will recognize the network before it becomes invisible infrastructure. Stay curious, stay informed, and keep watching the pipes beneath the system. Because if Garlinghouse is correct, XRP isn't just part of the future financial stack. It is the stack.